Ladies and gentlemen, I'm on the no sovereign money side here. But I have a confession to make. I actually feel quite some sympathy for sovereign money. Like Katharina said before, wait for it. Like Katharina said before, I also think that some things got horribly out of control with today's financial system. In fact, I'm one of those two guys who have written a book that calls for the end of banking. But before the organizers of today's conference now start to get nervous and think that I switched side last minute, I'm not. I'm actually absolutely convinced that we have to reject sovereign money. And the reason why I think so can be found in the subtitle here, Money, Credit, and the Digital Revolution. The digital revolution is a total game changer in finance. And no, I don't mean primarily fintech or the blockchain. No, IT has already reshaped finance decades before Satoshi Nakamoto came up with his white paper. And while we're already looking at this slide, I might have to clarify another issue. Because for my boss at Neue Zürcher Zeitung, a liberal daily newspaper here in Switzerland, the cover was once a bit of an issue. He told me that it appeared slightly too red. So, rest assured, this is no communist manifesto. I'm a liberal in the classical sense, and as such, I do believe in economic freedom. And with economic freedom and the digital revolution, we're right at the heart of my critique of the sovereign money initiative. First, sovereign money, my claim actually is that by mishandling the digital revolution, sovereign money will slowly suffocate economic freedom and at the same time fail to protect us from another devastating financial crisis. And that sovereign money is actually planning to curb economic freedom. They're quite open about it. Just look at the first paragraph. Sovereign money has to restrict economic freedom because it's based on an outdated idea. Positive money, 100% money, Vollgeld, sovereign money, these may all be new in name. But it's fair to say that their underlying reasoning dates back to the idea of narrow banking. Narrow banking was first proposed by Irving Fisher in the 1930s. This is 80 years ago. So the fundamental idea behind sovereign money originates from a time when banking was still a pen and paper-based business. This is a huge problem because this is the reason why sovereign money will run into the exact same problems as today's regulatory approach towards banking, namely, ever-increasing regulation. Let me explain that, and for that we have to go back in history a bit as well. It was in the industrial age where banking was a decisive factor in realizing large industrial projects like factories and railroads. Banks did that by, on the one hand, issuing long-term loans to realize such projects, and on the other hand, enabling lenders to make short-term small deposits that felt as good as money. In other words, banks created money out of credit. We heard it today a couple of times. The problem is that this is a fragile business model. History has shown that time and again. Bank runs happened frequently, and sometimes they escalated into full-blown banking panics. Banking panics can drag the whole economy into a downward spiral. Banking panics trigger things like the Great Depression. So no wonder, already back then, people started thinking, how can we prevent this banking-induced economic disasters? It was the birth of narrow banking. However, this ideological ancestor of sovereign money was not implemented. Instead, a regulatory framework was designed and implemented, which is still in place today, and which I call the carrot and stick approach. The carrot being deposit insurance, implicit government guarantees, and liquidity to access to central bank liquidity. Problem is, these guarantees, these banking privileges, actually prevent banks from collapsing and prevent the banking panics happening. But at the same time, they incentivize banks to take excessive risks. This is well known. So society needed a stick to keep a control of that, banking regulation. How this carrot and stick approach evolved over the last decades shows why sovereign money won't work in the 21st century. Let me elaborate on that. Well, what's the natural reaction if you face a juicy carrot, but you know somewhere in the back there's a stick lurking? Well, you try to snatch the carrot while avoiding the stick. Bankers are just like everyone else in this regard. And actually, regulators face this problem in many industries. For instance, manufacturing companies will always try to circumvent costly regulation. But there's one difference with banking that makes all the difference. Banking is an entirely virtual business. It's human imagination in its purest form. It only deals with figures and numbers. Now, there was a time that this carrot and stick approach seemed to work a bit. So that was up to the 1970s. Back in the industrial age, something was different to today. Back then, there were technical constraints to banking. If you think back in the industrial age, bankers had to record, confirm, and reconcile every financial transaction with pen and paper. It's hard to imagine today, but back then the banking book was an actual physical book. And this forced bankers to keep things simple and contained. Banking, the creation of money out of credit, happened on one balance sheet. For regulators, this was a dream. They just had to walk up to the bank, look at the accounting books to check if excessive risks were taken. Now, the digital revolution changed everything. The digital revolution mobilized credit. With the help of information technologies, it was now possible to slice, dice, and redistribute financial contracts across balance sheets and jurisdictions at high speeds and low costs. Information technologies allow to move credit from one balance sheet to another one with just a few mouse clicks. And this was a regulator's nightmare. It's why we've seen this explosion in regulation over the last 40 years. In the 1980s, the first Basel Capital Accord, Basel I, was introduced. Basel I got quickly circumvented, so it was time for Basel II. Basel II wasn't even fully implemented, and it already proved flawed. So what are we doing now? Well, we tried with Basel III. I'm convinced that Basel III will fail as Basel II and Basel I did before. Let's have a look at the finance in the digital age. This slide is from a New York Fed staff report in 2010. It shows the shadow banking sector at the eve of the financial crisis. Every tiny square there, it's hard to see, I'm sorry. Every tiny square represents a stylized financial entity, the balance sheet of it. So one square stands for all banks, one square stands for all money market mutual funds, and so forth. And the lines are financial interactions. Looking at this web of complex balance sheet, you realize that trying to secure financial stability by focusing on the single institution bank is doomed to fail. In the digital age, banking is no longer confined to this single banking book, but it has moved into the system. And sovereign money runs into the exact same problem here. And the problem is, if we look back how regulators in today's approach dealt with that, we see that they still try to focus on that single institution. And this is a slide I did for Neue Zürcher Zeitung. It's an analysis of how many regulations have been devised over the recent years. It's pages of regulatory text issued by the Basel Committee. The bars are numbers of pages. And you see that in the years before the financial crisis, the Basel Committee issued more than 1,000 pages. It goes without saying that within this like regulatory jungle that hinders entrepreneurship and innovation. Mishandling the digital revolution slowly suffocates economic freedom. And sovereign money runs into the exact same problem. Sovereign money will fail because of smart bankers who are equipped with digital technologies. If we implement this initiative, new financial assets will quickly be designed that are money-like the deposit that are prohibited. Assets like money market mutual funds. Now, if this happens, the proponents of sovereign money would say, that's not a problem because the Swiss National Bank could just implement minimum holding periods. And here we are, back to the concept of economic freedom. Because minimum holding periods are no easy task. The SNB would have to start monitoring all transactions with these funds and step in if people sell too early. And of course, it wouldn't stop with money market mutual funds. The SNB would have to monitor more and more financial transactions and check whether money is created again. If we implement this initiative, the SNB is really set for a race it's bound to lose. Because in the digital age, virtually every financial asset can be used to create money out of credit. Banking is no longer this paper-based business that is confined to one balance sheet, but it has moved into the system long ago. The digital revolution is really the game changer here. And we paid a heavy price for not acknowledging that over the past 40 years. More than that, we're not realizing the full potential these new technologies have. IT would allow for a truly market-based financial system. Many developments in finance already show that. So let's finally embrace the digital revolution. It's true, the financial system is broken. Katharina was totally right, and the slides by Martin Wolf showed that too. But let's not repeat the mistakes we did with the current approach towards banking regulation. And this is why, even though there are quite some likable aspects about sovereign money, we have to reject this initiative. Thank you very much.